All right, so we're picking up on discontinued operations. This is something we didn't really talk about very much in principles, so we're diving in deep to it now. So an entity can have different um, components of their operations. When one significant component of that is discontinued, then they have to follow the rules for discontinued operations. Okay. It usually represents a strategic shift in how the business is going to go. It's a major effect on the company. So they may be getting rid of a whole section of their operations. All right. So here we have we're just picking up from the income from continuing operations. Before income taxes, we have our income taxes and then income from continuing operations. Now, notice income from discontinued operations. This number is always net of the tax. Okay. It we don't have, it didn't come before this line. It's below our income from continuing operations after taxes. So this line item here is net of tax. They told us it was 25%. So we will have 50%, I'm sorry, $50 tax expense. Okay. So let's move on over here. So there could be two different components to this. So it could be the income or loss from the operations of the component, beginning of the reporting period to the disposal date. So as soon as they figure out they're going to discontinue this component, it automatically enters this realm of it's going to be disposed of. Okay. At that point, any income or loss on the operations gets also put into that net of tax number below income from continuing operations. Then we can have the gain or loss on the disposal of that component's assets. Okay. That would also be net of tax. Okay. So they give us an example here. This is on October 2027. Management of Duluth Holding Company decided to sell one of its divisions that qualifies as a separate component. According to GAAP, on December 18th, the division was sold. So we're going to consider the facts. So the first thing here, from January 1st through the disposal, the division had a pre-tax loss from operations of 5 million. Okay, I'm going to write that down. Okay. Then the assets of the division had a net selling price of 15 million, but a book value of 12 million. Okay. So now we have a gain of 3 million. Not enough to offset it all, but we end up with the net of $2,000 loss because the loss of 5,000 coupled with the gain of 3 gives us a $2 million loss. Okay. It is net of tax, 25% here. So 500,000 is a tax benefit. Okay. That's a tax benefit to us. Okay. When it's a loss. Then we have the net amount loss on discontinued operations of 1.5 million. Okay. And then that brings our net income, or it brings our 20 million down to 18,500,000. But you can see how we want to put this as a separate component and like separate it out because it's really not something that's going to happen over and over again. So it has to be classified as a discontinued operations. Okay. They give us another, nope, they don't give us another example. They do down here. I just was trying to skip too far ahead. All right. So when the discontinued component hasn't been sold yet, it still has entered that realm of discontinued operations. Okay. So let's look at this example. Very similar, but they said they had a division loss of 5 million and they ended up, oops, sorry, and they ended up with their assets. Assets had a fair value of 9,000, but we're carrying them on our books as 12,000. So that's a difference of $3 million. That is also a loss. Even though we haven't completely disposed of it yet, hasn't been sold yet, we are still going to put that $8 million loss into our financial statements again below income from continuing operations. We get a $2 million tax benefit on that. So it hits our bottom line of 6 million, brings our 20 million down to 14 million. Okay. And there can be a gain. In that previous one, we had a gain on the sale of the assets. You could have some income, but it might not be as much income as you want or as your investors are wanting. So you want to get rid of that whole component of that business. Okay. Here is a disclosure. Here's where they disclosed everything that was attributed to a discontinued operations for Campbell Soup Company. So all of those things right there, you can see all of the assets, liabilities, and let's see here, liability. Okay, that's what they got rid of. Okay, in a very, very complicated journal entry, they would get rid of all of that. Okay, I'm not going to do these little problems because these videos can get very long. Um, One quick thing to realize, I have these PowerPoints pulled over into OneNote, but if you actually go and download the PowerPoint slides that I have in Canvas, there is a lot of notes that go along with them. I use them when I'm lecturing y'all, but I was thinking tonight, I was thinking that would be probably something really good for y'all to know to where you could go and look at that and might be something good to read like right before you go into a test. Okay. All right. So now we're going to jump into accounting changes. Okay. Accounting changes are going to fall into one of these three categories. Okay. Accounting principle, estimate, or reporting entity. Okay. A correction of an error is another adjustment, and it's accounted the same way as other certain accounting changes. So let's dive into these. Okay. A change in accounting principle. Okay. This happens when we are going mainly from one gap method to another gap method. Okay. We could be using a retrospective approach. That means going back and restating everything. That's usually done when your inventory, the way you value inventory, LIFO or FIFO, has changed. You want consistency, and that LIFO and FIFO makes a big difference in the financial statements. Okay. So if they change, then they do have to go retrospectively. Okay. Modified retrospective just means that we are going to take like one big cumulative hit on the current year's financial statements, and then we will go forward from that point. Okay. Prospectively goes forward only. Okay. That just goes forward only. There can be voluntary changes in accounting principles accounted for retrospectively by revising prior year's financial statements. Okay, I just mentioned these could be inventory method, depreciation method, or revenue recognition method. Sometimes GAAP changes and you're forced as the company to change to meet GAAP standards. Okay, let's talk about change in estimates. Okay, remember change in estimates? These are the things that we come up with a very good estimate, but we still don't really know if it's exactly perfect. Okay, when we are calculating depreciation, we know what the cost is. That is the one thing we know, but we may estimate that it's going to have a useful life of 10 years. It may have 15, it may have 5. Okay, right there at that moment, you're making the best decision you can possibly make with the information you have. Okay, I kind of equate this to parenting. It's real easy to look back and say, "Hey, I should have done this and I should have done that," but at that time, you made the best decision you could with the information you had. And we don't get the luxury of trying two or three different things and then, oh, let me go back and pick the perfect one. We don't get that luxury. Okay. We do the very best we can with the decisions we make right now. Okay. How to account for bad debts. That could be one, the useful life residual value of a depreciable asset, or it could be any future warranty expense. So those are change in estimates. They just go forward. There is no prior year adjustment, nothing going backwards. Prospectively is moving forward from this period on. Okay. Change in depreciation, amortization, or depletion, all of those are accounted for the same way as a change in estimate prospectively. So you can almost kind of look at a lot of changes for um, property, plant, and equipment, intangibles, and natural resources kind of have the same rules. Okay, so they go prospectively because we may change how we estimate it. We may change which depreciation method actually may work better. Okay. So works exactly the same way as a change in estimate. Okay. All right. Now let's talk about a correction of an error. That's a whole different thing. I remember when I was studying for the CPA exam, when they were trying to contrast these, if you look at those other ones that we just looked at, one gap method to another gap method. When you're doing a correction of an error, you're going from a non-gap number to a gap number. Okay, you did something wrong. Okay, and there is a journal entry needs to be made to fix it, and then there needs to be a prior period adjustment recorded. Okay, and how they would do that, let's see if they go, how they would do that, it would offset, they would decrease or increase the beginning retained earnings is how they would handle a prior period adjustment. That is if it is material. Okay, only if it's material. If it's something really small, it's okay. Okay, we're looking for material misstatements, things that would have changed our mind on investing in this company or not. Okay, we would fix any balance sheet accounts, income statement accounts, and there would be a disclosure note that would communicate that impact on the prior period's net income. All right. So the next thing we're going to talk about is earnings per share. This is a much bigger equation than we've kind of looked at before on earnings per share. We have net income minus preferred stock dividends, okay? Because remember, preferred stockholders get their dividends first, okay? So, in order to calculate just basic earnings per share, we are going to take the preferred stock dividends out, divided by weighted average number of common shares outstanding, okay? So, in what will happen sometimes is that we will have a security, maybe a bond, that is convertible into equity. Okay. If that happens, then it could have a diluting effect on earnings per share. Okay. So here they did the calculation, earnings per share of 0.30. Okay. I'm not sure where they got these numbers from. I'm guessing that was a problem in the book, but you can see 30 cents per share. Okay. So there could be some securities that would have a potential to lower that, dilute those earnings per share. And I believe we go into this a lot more uh, in more depth in another chapter, and actually do a lot of the calculation of diluted earnings per share. There could be a security that would be anti-dilutive. If it's anti-dilutive, that means it made the basic one go up. We would not disclose that. Okay, but we do want to disclose diluted earnings per share. A bond that can be converted into common stock would be one. Preferred stock that can be converted into common stock, that would be another thing that would be very dilutive. Okay, there could be some stock options out there that if were exercised, that would dilute the earnings per share as well. Okay, and here we have the earnings per share disclosure for Emerson Electric, and you can see they have earnings per share from continued operations. They also disclose that with discontinued operations because we are trying to tell our users every bit of information. Okay. Then they have the dilutive. They did not really go through the calculation with us here. I believe we will do more of that. in a chapter or two. Okay. All right. So you can see it's not a lot, but it is dilutive nonetheless, because you can see right here is basic. Here is dilutive. It's only 3 cents. It doesn't seem like it's a lot, but if you think about 3 cents on a million shares, that's a lot of money. Then for 2023, it was $23, and then it'll go down to 22.88. Okay. All right. That is all for this video. I will see you in the next one.